All right, so good morning. This is Trent. So today I want to talk about how I'm looking at when trends are happening, when they're changing, when stocks are a good time to buy or not to buy. So I have this notebook here, as you can see. It's called the High Performance Habits. I recommend the book. It's great for zoning in on what you're excellent at and creating the habits. Well, it comes with this notebook, and every day I will take notes in my notebook of things that indicators in the market that I am paying attention to. So there are three things I'm looking at. I'm looking at volume, I'm looking at price, and I'm looking at volatility. So those three things are I'm basing my decisions on where the trend of the market's going or trend of the stock's going. If it's about to turn, if it's about to get super volatile, or if it's falling volatility, if it's a good time to buy because then it's moving up. So let's break down volatility today. I believe volatility is a biggest leading indicator to what is to come. Okay. When volatility spikes, you're starting to see risk off kind of situation. So for instance, yesterday in the NASDAQ 100, the NDX is which I follow. The VXN is the volatility index for the NDX. Okay. So yesterday, midday, I saw a spike of 17% up in a given day. All right. In that day yesterday. And yesterday was the 13th of July. So when I look at that and I see that, that trend, and I'll show you a chart here in a second, a trend down over in volatility, and then all of a sudden a day where it spikes up, it tells me that we are going to see a rotation out of high risk assets like the NASDAQ 100 and into less risky assets. So if you go to the MOVE index, which is the volatility index for the 10-year treasury, okay, MOVE index, MOVE index, it's hard to find it, but if you can find it, it's a good indicator of what the volatility is in the 10-year treasury. And what we see is a continuing falling of the volatility in the MOVE index. And what that tells me is people are buying into the 10-year treasury. And the reason they're doing that is because they're scared of what is coming and what is happening in the world. So if you look at the 10-year treasury over the last, say, 2 years, you will see that yield has fallen. And when we get fear spikes, you see the MOVE index go up and people are getting scared. But when you see the MOVE index go down and continue to go down, there's less volatility there. That means more people are buying into the 10-year treasury. So compare the correlation between the NDX, NASDAQ 100, and the 10-year treasury, okay, and their volatility indexes. So the VXN and the MOVE index. And what you saw yesterday was the VXN's volatility spiked and the MOVE index continued to go down. So this opposite correlation, I want you to start thinking more and more about how things are correlating within your portfolio. Okay. So this is what it's telling me today. This is earnings season, July of 2020. We're end of second quarter. We're in the biggest phase of this coronavirus. Cases are going up. I know here in Florida, I think it was 2 days ago, we had a case count jump up to $15,000 confirmed cases in a day. According to my doctor, you're going to see 20,000 cases in the very near future, probably the next 7 days or so. Don't take that as gospel, but it's her estimate, and she's really on this. So I'm looking at the volatility in equities, and I see that in the VXN and the volatility there, and I also see it in the VIX, the volatility index, which is related to the S&P 500. Now, most people look at the S&P 500 as the gospel, along with the Dow Jones, which is really not a great index to base your overall stock performance thinking on, because it's just 30 stocks and most of it's just old stodgy stuff, right? whereas the S&P 500 is 500 stocks. So I'm looking at the VIX also in relation to the S&P 500. And once again, yesterday we saw a jump in volatility in the VIX. What that is telling me is that volatility is starting to spike again, which means fear is coming into the market, which tells me that I need to look at what is going to oppositely correlate to my equities so that I can hedge, in a sense, that downside risk in equities and with something that will go up. So I'm looking for something that is falling in volatility. So I'm looking for asset classes where volatility is falling in comparison to asset classes where volatility is going up. See how this is happening? You neutralize your portfolio. You oppositely correlate your portfolio. So where I'm looking at is, of course, in 10-year treasuries, 30-year treasuries. I'm looking at the ways I can buy those indexes. And I know you'll look at me and go, why would I buy the 10-year treasury, which is, I think, right around 0.66% in yield? I'm not going to make any yield. That's not the point of this. If you had bought the 10-year treasury or the 30-year treasury at the first of the year, you'd be up double digits. Okay. What is this all about? This is all about making money, right? Making money and risk managing. So what I'm telling you is you are buying treasuries or treasury type of positions like the 5, 10, now the 20, which is brand new, and the 30, because you are hedging this portion of your portfolio, this equity portion. When this equity portion goes down, you want your hedge, your oppositely correlated positions to go up. So you neutralize your downside risk. I'm telling you this because at the end of the day, if you neutralize your downside risk, your upside returns will take care of themselves in the long run. The less you lose in a market that we're in the volatility, the more you're going to gain in the long run. Okay, there's less you have to make up. So let's review really quick. I'm looking at the volatility in the equities. So, for instance, the Nasdaq 100, the VXN. Okay, VXN jumped yesterday. I then look at where is my oppositely correlated, where can I hedge, and I'm looking at the MOVE index, which is related to the 10-year Treasury, and we're seeing that go down. Okay, so oppositely correlated. I'm buying and allocating positions to take the edge off of this volatility I'm experiencing in equities. And what in end, the value of the S&P 500 or the Nasdaq 100 will go down, and the value of the 10-year Treasury, the value of the 10-year Treasury, not the yield, the value will go up, and I will counter this down in the equities. Do I one-to-one counter it? Am I neutral completely? No. Am I going to lose a little? Probably a little bit. But here's my next step. When I see the volatility in the VXN and the VIX top, in a sense, right? The volatility is up here. The MOVE index is down here. Okay. When I see it topping and I see the volume decreasing, volume is very important. Volume decreasing, I will start reallocating new cash back into my riskier assets, into my equity portfolio. So I'm buying low and I'm selling high. So when I see volatility peaking in equities and bottoming in treasuries, I will buy on my equity side, start overweighting my equity side, not totally get out of my hedge, because I'm building a diversified risk managed portfolio. And as the VXN and the VIX fall, the values of the equities will go up, and I will make money. That is the strategy I'm using. That is why I'm looking at volatility. Check it out: VXN, VIX, S&P, Nasdaq 100, VXN, and the S&P 500, the VIX. And check out the MOVE index if you can find it. The MOVE index for the 10-year Treasury. Look at correlations, right? When you're buying real estate, what are the three rules? Location, location, location. when it comes to buying stocks and bonds, correlation, correlation, correlation. Remember that. All right, go out there, do your homework, be aggressive, think outside the box, quit listening to the talking heads. Do your homework. Risk manage. Peace.